Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our expert Vinit Bolinjkar of Ventura Securities and Kalra of Target Investing join me on the show. Today on Hot Money, we'll discuss the Adani Group stocks, whether it makes sense to accumulate Adani Group stocks after the big fall that we saw yesterday. We discuss what should one do with Escorts. The counter has already fallen significantly from the recent highs. Is there more downside? Is there more pain in the tractor sector? We discuss the NBFC stocks. Is there some stock that our guests like in the NBFC space? Is there more traction that could come in? That's what we are asking. And finally, what we ask is the media stocks. We've seen a big fall that's come in Z as well as Sun, but the recovery has also been very sharp for companies like Z. Would they accumulate any of the media stocks? So that's something that we are asking for. First, let's start with the first one, and that is the Adani Group stock. So day by day, we are seeing group stocks taking a hammering. Yesterday, it was the day of the Adani stocks. While counters like Adani Enterprises, Adani Power, Adani Ports fell in significantly, today seems to be somewhat of a rebound in all these stocks. So what's the view ahead for Adani stocks? That's something that we'll ask. Vinit, what did you make of the fall? Obviously, it did happen, but after the fall, is it time to accumulate? Would you accumulate any of the Adani Group stocks, or would you stay away?
We would stay away from the Adani Group stocks, primarily because, if you look at the group debt level, is about 1,12,000 crores. If you take the entire book value of the entire group, it's about 20,000 crores. So your net debt to, it's 44,000 crores. So your market cap to debt is quite steep, almost three times. And if you take net debt to EBITDA is 5.6, because your group profits are only, EBITDA is about 20,000 crores. So, a GMR, GVK and a Reliance are lessons to be learned, that when the incumbent changes at the political level, all these companies which are related to the the larger economy on the infra side get impacted severely. So, this net debt to EBITDA being almost 5.5 times is very, very uncomfortable. Of course, the group is on a very large capex spree. They're expanding in all directions. But, if anything can go wrong, and if Murphy's Law is to prevail, then I think, you're better off away from these counters. But if at all you want to take a stake in this counter, I think Adani Ports is a much safer investment in the Adani Group.
Sure. Any reasons why?
So things are all much under control. Operations are old. Cash flow streams are very positive. So that is why we like that.
Okay, so stay away from Adani Group stocks, and if you have to take a bet, stick to Adani Ports. Samir, what's your view on the Adani stocks?
So I think we've stayed away so many years from these stocks, and there's no harm another couple of years. Because what is happening, they are going very aggressive on the capex. They are already highly leveraged. They are taking international operations, which is very difficult to manage in terms of financials and operational. And they faced a lot of legal issues over there as well. And what I feel is now when you're going into elections, you really don't want to get connected to a politically linked, let's say, companies. And you want to stay away from them, at least till the time the results are out and everything is sorted out. So even otherwise on the fundamentals, I wouldn't suggest any company out of the group, because what is happening, even if Adani Port is getting a good cash flow, that is getting drained by other companies, because then there are these funding and related party transactions which happen and consume that cash. So I think as a whole, the cash is going out into that higher capex of the group plan, and I think over there it's better to stay away.
Okay, let's leave aside the political implications and the connection here. Do you think it's a case that the group decided to grow to fast in a very short span of time, and this debt could be a big problem, as Vinit pointed out?
See, the whole point is, if you're doing some kind of a capex where you control the pricing, it's still better off. But if you see the port systems, the shipping movement controls the prices, which is beyond you. If you go on the commodity side, the global trends control the prices. Anywhere which they are doing capex, the pricing control is not in their hand. And that really puts a pressure on the books. So any kind of a slowdown globally, which people are talking about, if it hits and the commodity prices crash down, then another shipping industry will also crash down. So the ports numbers will also diminish. So I think you're looking at a better picture. It might get worse from here, and this is not where fundamentally also you want to be there.
Okay, before we move on, Vinit, do you think that they will be in a position and their cash flows are strong enough to repay the debt? 1 lakh crore is no, and lessons have been learned from GMR, GVK and the Suzlon. What about Adani? You think that their cash flows and the current state of operations, they will be in a position, at least not now, but after 4-5 years, in a position to repay this debt?
See, I'll give you an example, is let's take the 9th round of auctions, which happened for the CGD. The incumbents who understand the business, Gujarat Gas, MGL, IGL, they all stayed away and they said that the biddings have been so aggressive, it has been 5 times the rate that we have bid. Our bids have been put. So I think caution has been thrown to the wind. So I am very circumspect, and I fear that another could get repeated. The only thing is that you need to have very lightning speed, precision controlled execution take place, and we have not noticed that in the case of Adani, that they have a legacy of doing good execution. So I would stay away from them.
Okay, so Adani is a clear avoid as far as our experts are concerned. The next topic we want to talk about is Escorts. Escorts is one of the biggest drags as far as the market is concerned. Obviously, weak set of numbers that came in. The commentary was also weak. The industry guidance that they said they've cut it this time around. What happened was last time around M&M did manage to cut it, and that time Escorts said that we will not cut it. We will continue to grow ahead. This time around they have managed to cut it, and off late Escorts has been a marked underperformer. Samir, Escorts, it's down 30-35% from the recent highs. Good time to accumulate, or you see pain in the tractor industry?
So I think the results have stabilized as of now. There will be a further downside, because what is happening, if you see tractor sales, 75 to 80% is financed. And on the financing side, what is happening, it's not just the disbursements having the issue. Even the sanctioning now has gotten more scrutiny. So that really takes off the demand, because earlier the scrutiny was much less. Now the scrutiny has turned out to be much more. So over there the demand automatically tapers off, and now the expansion of capacities, dealerships, whatever has happened for past couple of years, especially in tractors, will face the pain in next one and a half years. So we see a lot of negative side in these stocks.
You think the high base will catch up with Escorts? M&M it did manage to catch up, but we see the auto sales number, the base is much lower. And growing ahead, do you think that the high base now will start catching up with Escorts going ahead?
See, it might take a couple of months to catch up, because last 2 years have been really good for tractors, especially Escort, because of the expansion on the dealer side also. So that might catch up in next couple of months, but yeah, it will catch up soon, and then the fall really gets hampered.
Okay, what about you, Vinit? What are you recommending your clients on Escorts?
So I think again, related to the change in incumbent government, railways was a big portion of their business, which was growing very fast. You have construction equipment growing very fast, along with tractors growing. Now all three will see a slowdown. So tractors, because of high base and because of, as he pointed out, excess scrutiny, and there is a complete imbroglio on the farm loan waivers, in many of the states. So you have Karnataka, Rajasthan, MP, Chhattisgarh. So all these states are in a kind of an imbroglio on the status of the loans. So I think banks will not get the money because the farmers will not pay. There's going to be issue, and then they would not be refinancing again. Railways, only NDA has a track record of spending money. And if you see the UPA government, plan and non-plan expenditure, there has been utter chaos. There is no planned expenditure that they've ever executed properly. So when you talk of railways, it obviously talks of capex. That is not going to come through. They do not have a history of that. And when they're going and talking of minimum income guarantee, and if they plan to do all that, our finances are going to be up for questioning. I'm not saying that the UP is coming to power, but if they were to come to power, then things would be different. So given the fact that we are sitting on a high risk situation where the government might change, so two of your largest contributors to your revenue are going to be suspect, and the stock is available at 12 times. Your growth in EPS is only about 9 times in 2 years. So 54 going to 63. So PEG ratio is also against you. So given all these factors, I think I would not want to touch the stock now. I see that the stock can come down much more from these levels.
Okay, so that's the view. Escorts, again, a clear indication, stay away from Escorts is the consensus verdict that we're getting in. The other pack we want to talk about is the NBFC space, and we've seen a lot of selling. Counters like Indiabulls Housing Finance, Dewan Housing Finance have actually gone more than half. They're down 60-70% from the recent highs, and there is traction on the negative side. Even stalwarts like Piramal Enterprises is down in trade. So a lot of selling has happened. So that's what we want to ask. Vinit, are you concerned about the situation in the NBFC space? Is there more potential downside? Or would you start nibbling into the NBFC space now?
No, I wouldn't be nibbling at these stocks.
Okay.
I would rather play HDFC Bank because I get a play through HDB in consumer finance. Okay. And for the NBFCs, cost of funds is a prime criteria. Second is they are all seen very heady growth. Their growth rates are tapering now, and they could actually turn negative because a lot of the disbursed loans are not getting sanctioned. Sorry, sanctioned loans are not getting disbursed. So there is going to be a slowdown. NPS could go up. So it's a quagmire, complete thing. So the operating growth that you have seen, it could collapse. So given these things, I think you need to be with the safe side. For the time being, NBFCs don't appeal to me. I would rather go with HDFC Bank, where I get a play on the NBFC side also.
Okay, what about then Bajaj Finance? Was that's
Bajaj Finance, I think, has got a 20% upside as on the basis of whatever valuation we do, and built into that is a 40% growth rate. Okay, so that's quite steep, and you have the Paytms of the world, all the wallets getting into that business. So for me, who gives me a better deal, I will go with them. And the way the Paytms and the other guys are burning cash, their game is right now to gain market share. So if their game is to gain market share, it could eat into the growth rate of Bajaj Finance. Okay. So now the business advantage is now coming to getting tested. So considering the fact 20% upside, 40% expected growth, what if your growth falters? Stock can get hit very badly. So to my mind, Bajaj Finance is a hold, but I would not be buying it at these levels. Okay,
so HDFC Bank is a safe stock. Samir, are you recommending any of your clients to start accumulating any of the NBFCs which have fallen?
So we have been doing HDFC Limited, LIC and Canfin.
Okay.
If you see, HDFC has raised around 18,000 crores since the whole thing unfolded. That's around 45% in the short term and rest in the longer terms. So over there they have a good amount of cash reserves for the growth and for what they are planning on the affordable housing. So I think over there now, when the GRU is out of the picture, they'll go on themselves and they'll be really aggressive over there. So I think that's a plus for them. On the LIC and Canfin side, the long-term funding was always the main source of the growth. There was now hardly 10-15% of CPs which were there, which were rolling in a 6 months period. So I think that's a benefit of LIC and Canfin. So we are sticking with these three as of now.
Okay, that's the view that's coming in. And which is a clear avoid at this point of time?
So I think Dewan Housing is a clear avoid. Shriram Transport is a clear avoid because the disbursements are taking a knock. And the funding is coming either through asset sales or the long-term funding, which is a high cost. So wherever these guys are able to increase the cost, there will be big faults because the accounts are smaller.
What according to you is a clear avoid in the NBFC space? You may not pick, but definitely not pick
DHFL.
DHFL. Because of the numbers that you saw?
Not because of the numbers, because there are umpteen cases where the sanctions are not getting dispersed. So it obviously shows that my loan book is going to slow down. I have a funding issue and my entire business model has collapsed.
Okay. So that's the view that's coming in. I think safe bets like HDFC Bank or HDFC seem to be the thing as far as the NBFC space is concerned, but the others stay away is the general sense that we're getting. And the last sector we want to talk about is the media sector. It's been in the news for all the wrong reasons. First, Sun TV saw a big drop that came in, trading at a 52-week low. Then the sudden drop and the margin trigger that came in Z Entertainment, and it took the entire Z Group down along with it. Z no doubt has recovered from the lows. It's back at levels of close to 400 now. But does this give you the confidence of taking bets in the media sector, or is this an avoid? So Samir, anything in the media space that you're buying?
So I think the media sector now is facing a regulation change from 1st Feb. So that will make it on more of the lines of the telecom, where I can choose and I can pay for what. Right now, the whole universe is taken as a compulsory universe. Now it will be voluntary universe. So the market shares, especially in the short term to medium term, will be affected. That will affect the advertising revenues of all these channels. So I think there's already a kind of a correction in that. I think this is a better place to be avoided for at least next 6 to 9 months, because these companies, certain of them are really heavy debted. So another advertising revenue hit might create a cash flow problem for them also.
Anything in the print side, because media is a large space. You're talking about the television and the DTH. Right? Anything in the print side that
print side, we like DB Corp, but the only point is it's good enough for the election time. Wherever you go, otherwise the newsprint costs have risen so high that these kind of benefits also go out of the margins. If you saw this results, the raw material costs really shot up. So I think all these factors come to a 0-0 sum kind of a game, and we still avoid it.
Okay, what would you buy anything in the media space now?
I would go with the radio stocks.
Okay.
So they make a lot of sense. We like the Times Group.
Okay.
That is one stock that we like. It clearly stands out. It's got very pedigree stock, elections, good growth, and advertising rates are also going up. So we like that. And if you were to look at the media stocks, so there are three things you have to analyze. One is the OTT threat, two is the market shares that they own, and third is the subscription game which comes in. Right? That impacts your advertising also. So now when I'm going to pay for a channel, which I want to see. Earlier I was just paying a blanket and I was not really knowing how much money is actually going and coming. But now when I sit back and do an evaluation, I just realized that if I was paying 900 bucks at home, I think it would come down to something like 300-400 bucks. So there's going to, in my opinion, going to be a clear-cut halving of revenues on the subscription side. Is a very good strong possibility. Number two is the fact that now your advertising revenues would now get linked to the number of subscribers that you actually have. Earlier you were selling as a package, so you could say that I got so many eyeballs. Now you have the number of subscribers, so your advertising is now going to get very targeted. The third thing is, with OTT coming in, your urban market is going to get disrupted. And not only the urban market, see, it's all about downloading an app. And today smartphones there are 220 crore smartphones, 120 crore smartphones. So it's available to everyone, and even in the rural, the disruption is going to happen. So given all these things, I think it is very difficult to pick a stock out here. I would wait for the tide to settle down around how this subscription game plays out. So I think let one quarter go, then take a view on that. But I think it's very difficult to fish in for any of the media stocks. Okay, so that's the view that's coming in on the media stock. Again, it's a difficult sector for which any kind of investments that could come in. But ENIL is something that, and the radio stocks is something that Vinit spoke about. But with that, it's a wrap on today's edition of Hot Money. Vinit and Samir, thank you so much for coming in today. Our Speak You comes up next. Stay tuned to Bloomberg Quint.